Well, the slowest economic growth, factoring in stimulus, is here, and more data only further solidifies that. The question is really, after a decade of quantitative easing, ultra low interest rates, and unbelievably massive risk taking on all levels, what in the world will they do to stop the next crisis? Will they directly monetize the debt? Will they buy every major stock? Will the government employ everyone to keep people working and then pay them with Fed QE money? Really, what exactly is the plan here? You came here for the truth, so let me unveil that for you. I'm asking that question. It's not rhetorical. I'm literally trying to figure out what exactly this plan is. It's unbelievable. It's unprecedented. We've seen nothing but failure in these previous instances, and yet they're going for broke. They are going all the way. Now, I wanted to acknowledge what I wrote here. Nobody will ever know they lied. I'm not talking about the statistic that I'm going to show you in a second with the revisions, the data revisions. That's not what I mean. When they produce a statistic, whatever that is, there's always going to be a revision later because we're getting preliminary data. Whenever they decide to revise it, nobody cares at that point. It's old news. Sure, it's available, but nobody cares. It can be the worst data ever after the revision. It's already priced in because that data was available 3 months ago or 6 months ago or whatever it might be. This is the way it works. That's old news. If it came out a day or two later, it might have an impact. But because it happened so long ago, this simply is ignored. Now think about how crazy that is. I want to show you this right now. January adds a much stronger than expected 225,000 jobs with a boost from warm weather. That's right, it's so sunny and warm, and that somehow makes everything better. Of course, I'm joking around, but they always use the weather as an excuse why it was bad in some cases, or in this case, hey, everything's fantastic. Well, it was because of the warm weather. They'll use any excuse in the book, positive or negative, and people don't really know. They just skim over that detail and they move on. January jobs, 1 month net change. This data here is a breakdown, and you could see it for yourself, but it doesn't get into the actual nitty gritty. These jobs here, when you look at them closer, many of these jobs are very low wage. I have shown you the breakdown in previous videos before. I can't do it again, but understand that you are seeing so many instances where the jobs that are put out there, if they are full-time, they are very low wage. We're talking $24,000 to $28,000. Now that's certainly better than nothing, but a lot of people can't make ends meet with that if they live in a city that has just average expenses. That's just the way it goes. Post-tax cut job gains weren't quite as great as initially thought. Oh, wait a minute here. Well, how could this be? This is what they do every single time. They output the data, later on it gets revised, and it is largely ignored. It seems to me, though, that the data is almost always revised down. It doesn't seem to get revised up. Isn't that interesting? Look at this. Directly from the BLS website, you can see the chart for yourself. It breaks it down because I'm trying to give you the data from the source. You can go out there and you can trust Twitter, whatever, doesn't matter. But I'm always bringing you the source itself so that you can track and trace this, empowering you as much as I possibly can. Payroll jobs growth year over year, and it's looking dismal. You could see the green line is the post-revision monthly change. Things don't look as strong, but this is what they do every single time. Doesn't surprise me, and this is the way that it's presented. They give it as data initially, and it's looking to be fantastic, and the promise of more growth later is always there. Yes, we're at this level now, but as soon as we do this thing, as soon as we can pass this law, as soon as we can make this happen, we are going to be able to get that even higher. So there's always that just around the corner, everything's going to get better, but it doesn't work like that. 2019 is the worst year for air freight demand since 2009. That's 2019 we're talking about. Could it potentially get even worse for 2020? We'll definitely see right now. When you look at 2019 though, the stock market, I'm pretty sure it did good. It performed well, didn't it? Well, you're looking here at two very different things. 2019's stock market and 2019's economy were absolutely not correlated. This just shows you the real deal. I've shown you all different types of freight. This happens to be air freight, and it's coming directly from the International Air Transport Association. So it's not as if we're reading it from some blog or from unconfirmed sources or anything like that. This is a very, very good indicator, and there are so many others. Just look at the Baltic Dry Index, something that I've been covering. It weakens and weakens and weakens. Look at industrial metals like copper, and you can see other data that when you piece it all together starts to paint the picture. But if I just focus on one thing, I always see the commenters, a small portion of them of course, oh, you covered this particular thing, well that's wrong. But it's not just that one thing, it's everything together. That's why I really commend everybody that comes here day after day after day, because you get the full package. I'm just showing you a snippet on any given video. Now this right here is out of the UN, and I definitely don't like what they talk about in here, but I wanted to point out something. The global economy is suffering a significant and widespread slowdown amid prolonged trade disputes and wide-ranging policy uncertainties. Poverty rates are increasing in numerous countries, and inequalities remain broad within and among countries. The important point here is the significant and widespread slowdown. There's no possible way to deny this. The information is there for anybody who is willing to actually look into it. HSBC says that the Eurozone economy might be at a turning point. Don't worry, the PMIs are looking up right now. However, German manufacturing, not so good. German manufacturing has continued to weigh, and industrial production figures out of Europe's largest economy sharply disappointed. Here's the chart that goes along with that. You can see the German industrial production month over month. Haven't seen it this bad since, guess what? Guess what? The financial crisis. That's right. This is what we see constantly. There's so much data that we're pulling out throughout 2019 and even in 2018 in some cases. It's looking terrible. And yet they're telling us day after day after day that this is the best, the most fantastic economy. And you look at that anywhere around the world. Same thing. China's GDP growth this quarter will be 0% according to top economist Ed Hyman. And he specifically noted the fact that this is trade. Trade is the problem right now. That's what he's focusing on, and that is significant. If we look at JP Morgan, they're saying the first quarter of 2020 real GDP will be 1%. Then somehow it's going to grow to 9.3% in the second quarter, third quarter 7%, and then it's going to slow down in the fourth quarter to 5.6%. I really don't know how they conjured up this type of data, but regardless, this is what we're seeing. Right now is a very interesting time because you see the real economy suffering. But then you have this, uncautiously optimistic. Investors' expectations nearing record levels. Greater than 62% expected probability of stock market rise over the next 12 months. I have shown you this similar chart from the lion's share before. Basically what we're looking at, I know it's a little bit small and the quality is not very good. This is as far as it can zoom in, but I want to focus right up in this area. As we have seen with the previous instances, these dots appear, and that is essentially this high level of optimism, and it happens to coincide with a dip in the market. It doesn't give you any indication that it's going to be falling tomorrow or anything like that. It's just something to note. The same activity right here during the financial crisis, the same thing in what we had 2015, 2016, and now looking at it more recently where you had the same exact pattern for early 2018, the market dipped down, and right now it's at a record level. As odd as this is, it's usually when people are most optimistic that things turn sour. Does that mean things are going to turn sour right now? No, but when we look back in the rearview mirror, that's what we're going to see. And what's underlying all of that? Well, obviously, the Fed's greatest liquidity boost ever, 12-month change in the US Fed Liquidity Index. This chart goes all the way back to 1969, and you can see how aggressive the most recent quantitative easing, repo operations, buying up everything in sight, how intense that has been. This is an interesting indicator, but again, just one of many. global central bank balance sheets. This gives us the Fed, ECB, the BOE, BOJ, PBOC, and the SMB all together over $20 trillion worth. The most important point is that during 2018, we didn't even really see a contraction of the balance sheets. We just saw the growth basically stagnated. And during that period of time, we had 93% of assets falling. What does that tell you? Not only do the balance sheets have to be very big, lots of money in there, but they have to increase. They have to continuously get bigger. And that's what I talked about, I believe it was yesterday's video, where the Federal Reserve in their own report was talking about how they need to print money through open market operations to keep the rates down. And as a result, the balance sheet needs to grow. That right there is very serious. Global central banks have been partly to blame for the years-long decline in interest rate. I can't even keep a straight face on that one. Let me try again. Global central banks have been partly to blame for the years-long decline in interest rates as their monetary policies become more accommodative, but they're hardly the only driver of the phenomenon, according to Jeremy Siegel. Dividends on stocks are going to be the new bond. I'm not even denying that, but this statement is absolutely ludicrous. Global central banks are the reason why we see what we see. Wall Street analysts have never been this bearish on Tesla. Tesla seems expensive at these prices even when valuing it like a high-growth tech stock. I show you these two because if we looked at it just a few days prior, you would see completely different information. If I'm focusing on the mainstream, I have nothing but all of these articles talking about how fantastic the stock is and you need to invest right now because the price is going to go to $7,000 a share. Suddenly the stock comes down and all you can find are articles like this. It's a whole bunch of garbage that they try to force down your throat. People need to wake up to the reality of what's going on inside the financial system. Top to bottom, it's rotten, so you need to manage this on your own. That's all for this video. If you found it informative, hit that thumbs up button. When you hit the like button, you are supporting this channel, so I do appreciate that very much. If you want to learn about e-commerce, if you want to understand it step by step, I created a free e-course that will teach you what you need to know, the AmazonGPS.com. Do you want a financial education that was not taught to you in school? If you read these two books, you will be able to get everything you need to know, that foundation, the history, the asset classes, all very, very simple, no jargon, none of that. Check it out, link in description. The audiobook is at themoneygps.com. Well, hold on. Have you seen this video? There's so much data in it. This is the one I was referring to a few minutes ago. If you haven't seen it, you have to watch it. Click on it and I'll see you there.